from the campus of the University of Pennsylvania Wharton School.
This is Behind the Markets on Business Radio.
Welcome to Behind the Markets here on Business Radio, powered by the Wharton School. I'm your host, Jeremy Schwartz, Global Head of Research at WisdomTree. I'm joined by two of my colleagues, one from the U.S., Kara Marciscano, who's a senior analyst on my team, on our research team, and also Rafi Aviav, the CEO of WisdomTree UK Limited. Please note, Kara and I are registered representatives of Foreside Fund Services. Our discussion is not tied to the offers of investment products and is not an endorsement or recommendation of any company, security, or investment strategy. The views of our guests are not those of WisdomTree or its affiliates. We'll be talking with Alex Moazed, who's CEO, founder of company Applico, who is a platform consulting business who works with companies to look at their platform business model. Is also the author of a book, Modern Monopolies. We're going to be talking with Alex, Kara, and Rafi about what's happening in the technology space, some of the developments in platform business models, just what is a platform business model, what is the case for them. WisdomTree works with Applico to license some of their data on platform businesses for one of our ETFs that we're going to talk about a little bit. But Alex, thank you so much for joining Behind the Markets. Welcome to the show.
Thanks for having me.
So maybe tell our listeners a little bit about Applico and what got you to start focusing on these platform businesses and got you to write the book Modern Monopolies.
Yeah, so platform business models, as we define them in the book, are the dominant business model of the 21st century economy. The reason why is because these businesses don't have one customer, they have two customers. They have a consumer on one side and a producer on the other, and they're asset light in the sense that those producers are actually creating and contributing the inventory into that platform, into that ecosystem. That's ultimately what the consumer is coming to the platform for, whether that's products that are listed by third-party sellers on Amazon or videos listed by content creators on YouTube or Facebook or Instagram. But all of these businesses are asset light because they have this two-sided customer nature to them. They have these network effects on both the demand and the supply side of the business, which means that at scale, they have a winner-take-all dynamic. There's only one or two given winners in any given platform market. And once you hit that winner-take-all scale, you naturally are kind of just a modern monopoly, hence the name of the book, which means you have the strongest profit margins out of any business model that we analyzed, and you have, really the most and strongest growth potential, the strongest defensibility and moats from other businesses encroaching on your territory, because it's just so hard to overcome these network effects and having these two different user groups on either side of your ecosystem. And what we realized is no one really has, identified and defined that business model and how it works and why it's so strong and why it's so dominant. And no one has really kind of codified that business model in the spectrum of the public equities markets. And specifically what Applico does, these large traditional enterprises, many of them incumbents, have not captured the potential of doing M&A and investing or buying a lot of these up-and-coming platform startups. That if you were to do an M&A transaction, it would be wildly accretive and prevent you from being disrupted and actually make you the disruptor.
I mean, I remember when I first heard you talking about this on another podcast and then reading the book and talking about this dominant business model. It was interesting that it's sort of a unique way of doing business, and these companies are today the fastest growing companies you find. I mean, I think we've looked at the basket and we're calling it a growth leaders basket. These companies are growing at 30% a year on average over the last 3 years, and it's well above it's sort of top decile for the S&P 500 for these type of growth rates, and well ahead of things like the NASDAQ 100, which is what people often think of as one of the prime growth markets. Why do you think this is the dominant, when you say dominant business model and how business is conducted? I mean, what sort of separates these guys in terms of why they're growing so fast?
I think once you are a once you're a public company, you've got a multi-billion-dollar valuation, you've hit some level of this critical mass. And so because you have the margins that you do, because you have the moats that you do because of the network effects and that winner-take-all dynamic, it allows you to continue to invest in growth and over-index on that investment, both from just a cash and capital flow of the nuts and bolts of your business, A, and B, because of the essentially the trust and flexibility that these types of companies have earned with investors on Wall Street. Predominantly probably because of those two reasons, these companies are able to continue to invest in growth. They have huge growth opportunities in front of them to either expand in their existing market or expand into adjacent markets. And so a number of the companies in the index you see are actually kind of this platform conglomerate status where they don't have one platform business, but they have multiple. And I think just solely because of that ability to grow, you actually see a lot of these platform companies, because of COVID, have continued and actually doubled or tripled down on investing in growth and are actually seeing a boon to their business because they're purely digital, because they already had a lot of growth opportunity. Now they have even more. And so actually COVID and because of these dynamics has actually been a boon to many of these businesses to just continue to grow even faster.
Carol, let me bring you in. I know you're focused on growth businesses, platforms with Alex and their team. And where do you want to go in the conversation here?
So I'm curious, you see a lot of businesses out there using the word platform in their financial filings, right? But obviously Applico as a consultant, you can't just be a platform and expect to have success. And that's where you guys come in and make sure that those businesses that are trying to be platforms are identifying the right industries or sectors or verticals to disrupt. So what do you think is the critical factor for success? And, of course, from the perspective of the investment side, you require more than just looking for the word platform. You guys go deep into the details of what's really driving the success of these companies. So maybe if you could just talk about some of those critical factors and what makes really a strong, powerful, pure play platform business rather than just a business that's using the word platform for recognition from the street.
Yeah, so what we look at and what we codify is what % of platform revenue do these public companies have? And you will find that as you said, there are many companies in their 10Ks and their annual reports will describe themselves as a platform company. Now, many of those companies just simply have no platform dynamics, right? They don't have any customer base. They don't have a concept of network effect. They don't have an asset-light business model. You just go down the list of here are all the characteristics of platform. Do you have that? And very often they actually don't. And you see that with a lot of SaaS companies that will say that their product is a technology platform. It doesn't mean that their business is bad. It just means that you don't have, again, that winner-take-all dynamic, the network effects, the defensibility, the lock-in that comes with having this two-sided dynamic on your business. If you're a SaaS business, you would need really like a community of app developers that are then making apps on top of your SaaS business, for example. And some of the companies or these self-described platform companies might have a platform dynamic. They might have, say, an app store with developers making apps on top of their platform or on top of their product. But what we look at is that % of platform revenue. Is this platform business, even though it might be legitimate, is it a material and contributing factor to the overall profile of the business? So you do see a number of companies that are trying to legitimately become a platform business in the way we use the definition, but they're not really at that tipping point, at that threshold for it to be a material amount of their overall revenue makeup. So that's really for the companies that actually do have the beginnings of a platform, that's what we're really dialing into is, has they really hit a level of maturity or scale with their platform entity? And the one caveat I'll add is some of the best platforms, even some of the biggest ones, like let's say Amazon or Apple, they are actually both. They are a hybrid business. They have platform revenue, and then they have what we would call linear revenue. And so for Amazon, they are white labeling products. They're a 1P reseller of products, and then they have their own white label products, not even getting into AWS and all the things with that, but just if we look at their product marketplace. So many of the best platform businesses that are in the index actually have platform revenue and linear revenue. So we actually like to see both. The question is that platform revenue a material amount of your business? So Shopify, for example, has two platform businesses. They do have an app marketplace on top of, their SaaS e-commerce product. And then they just launched the Shop app, which is a product marketplace to let consumers buy products from Shopify's actual SaaS customers, these merchants. Neither of those businesses really have a material amount of revenue contribution to Shopify. They may eventually in the future, but when you look at where does Shopify's actual revenue contribution come from, it's from them selling their e-commerce tools and SaaS offering. So that could change in the future, and they could provide more definition on those revenue streams as they become more material. But right now it's still nascent. So when you look at the competitive makeup of that business in the landscape, they don't have that same equivalent defensibility or moat as you would if you were one of these dominant platform businesses.
Let me just reintroduce our guest here quickly. We've got Alex Moazed, CEO of Applico, Kara Marsiscano, Senior Analyst at WisdomTree, Rafi Aviav of WisdomTree in London. Rafi, you focus a lot on tech trends generally in some of the products you guys focus on in Europe, and I know your personal interests are in tech. Any sense of how you see what Alex is focused on? Some of the things he just talked about, SaaS and platforms. Where do you want to go here?
Well, I think, thanks, Jeremy. I think I agree with Alex in terms of how he's characterizing the platform businesses and definitely some of the advantages. And today, when we look, we can already see a multitude of platform businesses as publicly listed companies, many of whom worth north of $10 billion. How do these start, these two-sided networks? How do you... Alex, how do you solve the chicken and egg problem of you need customers to get the providers, you need the providers to get the customers? How, have you seen any sort of particularly successful model of doing that? Or what are the tools available for entrepreneurs today to start when they start a platform business?
Yeah, I mean, that's the billion-dollar question, or I guess it could also be the trillion-dollar question these days. Solving the chicken and egg problem is a challenge that every platform experiences not once, but literally at every stage of growth, right? So it is the single most recurring problem and challenge that every platform will have to overcome repeatedly. And there are a variety of strategies that you can employ to overcome it. When you look at how a lot of platform businesses get started, usually, you need a couple things, you got to check a couple boxes off. One, you got to start small. You got to start bottom up, right? If you try to enlist participation from either large customers or large suppliers, that's not a good. You don't have much leverage over them, right? You want to start where there's a lot of fragmented supply and a lot of fragmented demand. And it's in these smaller users, those more individual, or if you're going after businesses, the smaller businesses, you want to start small. You want to start with highly fragmented supply and demand. It is in those areas where you can now start to enlist some form of demand and some form of supply. When you think about, okay, on which side of this do I start if I can't go after both sides in the beginning, right? So a lot of the time you'll see businesses start as a linear business, either focusing on capturing supply or focusing on capturing demand. There's a myriad of examples of, going in either direction, which is really just industry dependent. But you can usually try to focus on one, build up enough traction either on the demand or supply side, and then you can try to open up your business to enlist the support of the other user group, either the consumer or the producer, based upon who is not already participating. So you'll see even from anyone like an Uber to go do this, where when they were opening up into new markets, they would just go hire basically black card drivers and pay them, daily wages and pre-book them so they could seed, 50 drivers in a market when they're going to go into that market and start driving supply. So, usually, especially a lot of these hyper-localized businesses, you might be solving for supply in a linear manner when you're entering that new market. Then you scale demand, and then you can start to open up and kind of platformize your supply. So there's a lot of different strategies to it, but you want to start small and you want to have heavily fragmented supply and demand. Spotify, for example, does not have any fragmented supply when it comes to music. There's basically 4 record labels, and they control all the music. Yes, there are a myriad of artists, but all of the rights to their music is basically controlled by 4 entities. Really, one entity, the RILA, is like the common industry group, that then negotiates the prices with Spotify. That's why Spotify's margins really aren't anything to write home about. Spotify has been making a huge push to get into podcasting. So that's heavily fragmented supply, basically free content, right? And so how can they take a fragmented audience of consumers and expand into a fragmented source of supply in podcasting? So that is why when we look at Spotify's business today, they don't have fragmented supply. They don't have a network effect on supply. There's no lock-in of supply. It's just who can pay the record labels enough, licensing fees to get that music. As they build a stronger and more formidable base of supply amongst podcasting, we expect to see more defensibility, more network effect, more lock-in come from building very strong tie-ins with that very fragmented audience of podcasters.
I love that example. I think it's a fantastic example of something people often talk about and confuse, which is the difference between aggregators and platforms. And it's all captured within that Spotify example. Would you mind just walking us through kind of what is the difference between aggregators and platforms, and how is that sort of perfectly captured by that Spotify example you just gave?
Yeah, I think, aggregator theory by my friend Ben Thompson, it's really around saying if you can capture demand, if you can be that main demand spigot and aggregate that consumption, then you, irrespective of if your supply is more linear versus platform, you will reign supreme, right? And as long as no one is disintermediating you between you and your customer, that demand source, then that's what matters, right? Platform theory is different because it actually says that the source of supply is paramount to the long-term success of the business, right? It goes hand in hand with having an asset-light business, goes hand in hand with having a winner-take-all market. Another example is Netflix, right? Netflix of recent has been on a boon with COVID and the shift to digital, but the next few years for Netflix are going to be drastically different than the past few years when they were literally the only game in town. I mean, as another case in point example, if you have a winner-take-all market, it is literally not possible for 5 companies in the span of 12 months to launch a formidable product on your turf, right? Think about iOS and Android versus Microsoft. Microsoft spending like $7 billion or whatever it was to buy Nokia and come aggressively after iOS and Android with like Windows Mobile or whatever they called it. And it failed, right? It was just a non-starter because there's no way that Microsoft, despite spending billions of dollars and already having some stuff in mobile, could convince developers to create yet a third application for yet a third operating system. Similarly, if you look at YouTube and Netflix have roughly similar revenue, But YouTube's defensibility, I mean, who is trying to go after YouTube right now? Vimeo kind of tried with IAC and Barry Diller, who understands platforms extremely well, by the way. He owns Expedia. He's done roll-ups with HomeAdvisor and Angie's List and Handy. The guy gets platforms very well. They pivoted Vimeo away from trying to be a pseudo competitor to YouTube. You can't compete with YouTube. It's a monopoly. Netflix, on the other hand, you got 5 competitors in basically 12 months. This is Amazon with Amazon Prime, Apple Plus, Disney Plus, Comcast Peacock, AT&T with HBO Max, maybe 1 or 2 others I'm forgetting. I don't know, maybe like, Roku. I don't know. Whatever it is, it's a lot of competitors. And now the next 5 years, when you look at their strategy, it's just create more content. And all that content is created linearly. They're buying or licensing or creating all of that content. It sits on their balance sheet. And although they show on their P&L profitability, if you amortize that content, today they amortize that content against a 4-year amortization schedule. If you amortize that content on a 3-year amortization schedule, Netflix is a wildly losing company in the sense of they're just hemorrhaging profit. So it really just comes down to, for me, profitability of Netflix is more of an accounting function of how do they amortize this very, I would say, top-heavy balance sheet. That's the whole proposition of supply-side network effect, right? Of platform model versus aggregator versus platform is it's an asset-light business. My YouTube videos don't sit on my balance sheet. So, when I think about that defensibility, the next few years of Netflix, their defensibility is severely hampered as compared to having a network of content creators that are actively creating content and contributing content into the platform for free or with some kind of rev share model, et cetera, et cetera. So, whereas you see Spotify going in the other direction, Spotify going from a linear kind of aggregator model to saying, I need differentiated fragmented supply. I need to move more platform, right, with the podcaster source of supply. Netflix doesn't seem to be trying to embrace this thing called user-generated content. And they seem to just be doubling down on, we're just going to be the biggest and baddest movie studio on the street. And it doesn't mean that Netflix is going to go out of business. I think the question is, does Netflix still command double the PE multiple that Disney does? And do investors start to see their business as less, of being just literally valued at double what Disney is valued? Or maybe does that start to chip away? Because if that starts to chip away, then the stock price starts to fall rather drastically. And so I'm not bullish on Netflix long term.
Interesting perspective there, Alex. One of the key words you keep talking about, natural monopolies and sort of winner take all. And, there's a number of examples. And you have a lot of the big tech CEOs testifying this week in Washington. When you think about, should we be worried as consumers about this competition in tech? I saw an interview this week with Bill Gates on CNBC where he was talking about how he thinks there's a lot of natural competition in tech and people shouldn't be concerned about the big monopolies, quote unquote monopolies. What's your sense on, are consumers being hurt? Does government have to step in to break these companies up? Is there a risk to that? What's your sense of the political winds of change?
I think that these companies will come out of any DOJ, FTC review unscathed, not because they aren't a monopoly and not because they aren't violating antitrust policy, but just because our officials are too inept to thread the needle on landing the case. And it's because they focus on trying to make the argument that consumers are disadvantaged by these platforms. And what they fail to understand is that by definition, these platforms have two customers, a consumer and a producer. And when you look at where do platforms take advantage of users first, on the consumption or on the supply side, it is 110% of the time on supply. When you look at what Microsoft got in trouble for in the 90s, it wasn't for consumers. It was because they were playing games with the different web browsers and bundling their browser and not letting other developers get freedom of distribution on Windows. And so it is always on the supply side that you see platforms getting in trouble for. When you look at what the EU is investigating Amazon for, which is Amazon competing unfairly with their third-party sellers. And that is the right conversation to be had. Now, you know, the EU tends to kind of take a shotgun blast where they like go after the platforms with like 20 different complaints. And then I think just kind of see what sticks. That is the one complaint which I think is appropriately targeted at the platforms, focused on their supply. And you can make an argument that if you treat producers as customers, which they are, who does Amazon make money off of? When you buy a product from a third-party seller on Amazon, Amazon is taking its fee from the seller. That's actually the customer of Amazon, is the seller paying Amazon, 15% of the purchase price. So if you treat sellers as customers, then the past 50 years of antitrust precedent actually fits rather perfectly, because if you ran the numbers, Amazon controls over 70% of the spend for a third-party seller in the United States e-commerce, right? So if you add up all the marketplaces that are out there, Amazon, eBay, Farfetch, RealReal, some of these boutique ones like StockX, Goat, etc. Amazon, for the total amount of products sold by third-party sellers in the United States, over 70% of them are being sold on Amazon. So if you are a third-party seller and Amazon takes action against you or treats you unfairly or steals your data and then uses it against you, which they do all the time, by the way, that can be considered an antitrust violation because you are a monopoly, because you control over 70% of the market. But it's not over 70% of the market of e-commerce. It's over 70% of the market for a third-party seller to sell their stuff through an online marketplace. Now, you got to narrow in that definition. And I just think that lens is what the DOJ and the FTC have failed to do. We'll see if the EU is able to stay focused and thread the needle on that. But, I'm not holding my breath. So I think largely the nature of the conversation in the U.S. is, again, it's like, oh, they take advantage of supply, but then they try and bring it all the way back around to the consumer. And they say, oh, but the consumer is also at a disadvantage. And therefore, you did things wrong, platform monopoly. And it'll just never work. Maybe they pay a fine of like $500 million and their stock will go up because the regulatory fear is gone. So, yeah, I think they'll be fine.
We have to take a short break, but we're going to be back. We have the full hour with Alex, Kara, and Rafi. I'm Jeremy Schwartz. You're listening to Behind the Markets on SiriusXM 132. We'll be back after a short break.
You're listening to Behind the Markets
on Business Radio.
Welcome back to Behind the Markets here in Business Radio, powered by the Wharton School. I'm Jeremy Schwartz. We're talking with Alex Moazed, CEO and founder of Applico. We've got Rafi Aviav, COO of WisdomTree's UK Limited. We've got Kara Marciscano, senior analyst on my team on research here at WisdomTree. Kara, we've been talking about platforms, and right before the break, we're talking about some of the regulatory risk. I want to bring you back into the conversation. What are you thinking about here in terms of platforms and where we should go with Alex?
So I think is really interesting is how you talked about how you would expect, for example, Amazon taking maybe a legal fee after some of these antitrust claims are settled and the stock actually responding positively. So is that correct to say that the real sort of headline regulatory risk for these companies like Google, Amazon, Apple, Facebook, is the threat then not getting broken up, or is it just sort of the threat of taking a hit to earnings, whether that be from legal fees or from limiting how much they can, for example, Amazon sort of take advantage of the suppliers on their site? Are these companies getting broken up a real risk in your view?
Yeah, I think 0% chance. They are so far away from making a valid argument that even sticks, let alone get to the point where it's not some kind of settlement or, they have some kind of different practices they implement or, give the FTC some kind of like transparency reporting or something like that. There is a whole spectrum of like mitigation protocols, between settling for $500 million and, breaking up the company. So I think breaking up the company, or, forcing the sale of these things and so on and so forth. I mean, we are just struggling to figure out how do we handle Chinese platform companies from operating in the United States, let alone, the DOJ figuring out how should we break these companies up, or is that even appropriate? I do think the appropriate recourse for how platforms should change, even the tech monopolies, it is around protecting supply, right? If you are a driver on Uber, if you are a seller on Amazon, if you are a content creator on YouTube, Facebook, etc., you need more protection, because if the platform kicks you off, or if the platform tells you, hey, Uber driver, instead of 20%, I'm taking 25%, you can't do anything. Or if they ban you or penalize you, there's usually no way that you can refute it or present another side of the story. And for many people, particularly on these like gig economy or service marketplace or product marketplace companies, and actually even YouTube, I mean, just about all these, once you're in that tech monopoly stage, you have people that have their whole livelihoods built up using really just one of these platform companies, right? Maybe two at most. So if you get banned and you have no recourse put in place, then, you're really at a loss. And that legitimately is where the government should help to protect these suppliers, these producers, where there really is only one channel. Hey, I'm an Uber, I'm basically a taxi driver. I can work on Uber or Lyft. It doesn't get more straightforward than that. Although you see continuously, like California AB5's law, as a complete travesty and completely missing the mark on what they claim is to try and protect the gig economy workers, but instead is really just a money grab so that the state can try to extract more fees from these from all companies that are hiring 1099 workers. So, it's really unfortunate to see. There's kind of the altruism around, we're trying to do this to help, people. But then in the reality of it, the way it never hits home on the actual delivery of the regulation, if there even is any. So yeah, the ability for them to break someone up, I in the next 10 years, I give it 0%.
While we're on these winner-take-all dynamics that you're talking about, we obviously are aware of some of those more mature industries where there's a dominant player. We've been talking about Amazon for a while now, but where do you see, I guess, what you could call like platform wars in immature industries where the dominant player hasn't emerged yet? One that comes to mind for me is, takeaway food with Uber Eats and Grubhub and the acquisition that recently occurred. What do you see for that industry, or any industry where you see you're waiting for an emerging dominant player?
Yeah, I think, food, we had hoped that there would just be kind of natural consolidation and you could have a couple players. I think all the players had kind of hoped that, just so you stop having platform wars. When platform wars happen, the users win, the consumers and the producers. So it's good for restaurateurs, although there's a lot of other things hurting restaurateurs right now, and it's good for consumers to have the platform wars continue. So, I think naturally there will need to be a winner-take-all dynamic, a number one and number two, and that third player will just be a distant third. So you're seeing that with the Uber and Postmates deal, and I think that eventually you will have to see some form of other consolidation as these markets seek to mature and actually drive profitability. And I think, what's going on with COVID will probably present some interesting dynamics and opportunities for that to happen. But I think other areas which are kind of up and coming is, I would say maybe two or three I'd highlight is financial service marketplaces, or I would call it these regulated industries with burgeoning platform companies in them. So I would throw financial services and healthcare in there, right? So In healthcare, we have Teladoc in here, and in financial services, we have Market Access. Market Access is the largest kind of bond trading platform that's out there. So, and Teladoc doing telemedicine and telehealth. Teladoc has maybe tripled its stock price in the past maybe 3 or 4 months. Market Access has also performed rather strongly, but these regulated industries have had somewhat nascent platforms, except for if you think about like the NASDAQ or ICE, which owns the New York Stock Exchange, right? Those are the stock exchanges have been around forever, but there are kind of this new age, this new breed of marketplaces in financial services and healthcare with Teladoc. So I think that's going to be interesting. And there's going to be a lot of action there, particularly in healthcare. The other area are these kind of like more boutique, many of them kind of like consignment product marketplaces. So, you see a Farfetch, you see a RealReal, you have a few other private product marketplaces with StockX, with GOAT, which Foot Locker invested $100 million into a couple of years ago. And StockX came out with their report recently, and they said that May and June were our 2 strongest months ever by a long shot. I mean, you expect every month of theirs to kind of be an improvement, but with COVID, not only was it an improvement over the prior months, but it was, by head and shoulders improvement. So you're actually seeing, and Etsy similarly, also in the index, that kind of niche like craft marketplace. I think they have maybe similarly tripled from their low in March or April. So Etsy's been on fire, and maybe was like maybe 50 or 60% up from kind of where they were in February before COVID. So Etsy doing very strong as well. So you kind of see these like niche marketplaces, kind of like consignment marketplaces, still performing very strongly and still relatively nascent compared to, just this overall shift in e-commerce or, in retail to e-commerce. And I think these digital behaviors are actually just going to continue to compound upon themselves. Obviously when retail stores can open up again, people will go back and be able to buy more stuff in stores. But the digital behavior acceleration, I don't think is going to slow down. And so you're seeing a huge boon to that. It'll be really interesting to watch some of these product marketplace, these niche product marketplace earnings releases that are coming up over the next few weeks. Many of them also in the index. So those would be a couple of the areas that I think will be pretty interesting to keep an eye on.
That compounding effect that you alluded to is really powerful. You talk about, consolidation among existing platforms, plus you already have the existing dominant platforms, Amazon, Microsoft. You have these burgeoning platforms in healthcare and financial services that you mentioned. That all, to me, signals, growth for platforms as a subsector, I guess you could call it, within the broader investment universe. So I wanted to turn to what you predicted in your book, your bestseller in 2016, Modern Monopolies. You predicted that 4% of the S&P 500 could be platform businesses and making up 13% of the index's net income by 2020. So we're here today, and very conservatively, just back of the envelope, I'd say there are at least 20 companies in the S&P 500 that are platforms. That's 4% of the constituents. If you're just doing it by count, by weight, that's 30%. Obviously, because you have those mega cap names in there. And in terms of earnings relative to the index, it's 20% of the index's earnings are coming from platforms. That's 5 years ahead of the prediction that you had originally. So what are if you have any updated thoughts on where you see growth for platforms within, the S&P 500 index or more broadly?
Yeah, I appreciate you bringing that up. We got some flack when we put those numbers out there 4 years ago now. Book came out 2016, and to me it just makes sense. And to me, honestly, we're still at the beginning. When you look at just the level of penetration that these companies have in the overall markets that they're in, it's still relatively small. And when you look at their ability, what are they doing right now? They are doubling and tripling down. They are just continuing to invest in growth. Meanwhile, you have everyone else kind of entrenching. So when you look at that dynamic, and they see the ability to expand into adjacent markets, they see, as we've spoken about, this huge kind of digital behavior acceleration. They're able to really, our theory going into this was, in a crisis or in a downturn, they're going to dip less and they're going to bounce back faster. And actually, in the dip or in the downturn, they're going to be able to continue to invest in growth, which we've seen. And that means that when there is a bounce back, they'll just be able to scale even faster. And we kind of had a little microcosm of this, right? The past few months, where we had a very brief but sharp decline, and then what looks like, we'll see if it continues, this kind of V-shaped recovery. And what you are seeing is just the platforms are leading the pack, and I think you're seeing that trend continuing going into the future, particularly as you see some of these platforms when they're in this like single-digit market cap billion tranche, and the ones that are able to step up into this platform conglomerate status, where they don't have one platform business, but they have multiple platform businesses, that they are able to benefit from the compounding nature of their network effect within their own conglomerate, right? So an example of this would be Uber versus Lyft, both of which are in the index. But when you look at Uber's ability to weather the storm of COVID versus Lyft, which is only in ride sharing, versus Uber has obviously ride sharing and Uber Eats and nascent business and freight and some other things which are more of a loss and just continued investment for them than anything. But Uber Eats has really been the saving grace for Uber platform conglomerate, particularly with everything that's going on with COVID.
Hey, Alex, how does one value these businesses? Like, we have, in the investment world, we're used to just discounted cash flow and an assumption on growth rate. And here with these businesses, you have not only the added difficulty of exponential growth sometimes. For some of these more mature businesses, it's not so much exponential growth, but you still see them investing a lot to solve for that chicken and egg problem on a continuous fashion, like you said. And a business like Amazon still not showing incredible profit, although the potential, everyone seems to agree, according to the valuation, is there. How does one go about valuing these businesses?
Any of these high-flying tech companies, whether they're platforms or linear tech companies, are pretty much all evaluated growth prospects, right? I mean, if they beat earnings, but they don't have as strong of a growth prospect for the next quarter or two that Wall Street expected, the stock falls. Is that the correct or false way to look at that? That's a whole other conversation. But everyone's looking at growth for these companies. But even when you look at the like Visa and Mastercard's world, Visa and Mastercard of the world, which which are, might classify as like older school platform businesses, still relative for them, they're seeing very strong growth in the market for themselves. So I think at least the investors and the stock, the biggest mover is the growth. Now, how do they have growth either in their core platform business, which I think that's the crazy thing about Amazon is, you look at like a Microsoft where they really had to kind of shift what that core revenue driver, that core platform revenue driver was, and they've done a fantastic job at making that evolution. That's not an easy evolution, right? But I think that's also why, because they've been able to make that shift, because you do have huge growth in the cloud and Azure and all these kinds of areas, that you've seen them hit the $1 trillion valuation status and perform very well with their multiples and so on and so forth. So if there isn't strong growth in the core business, then they need to invest in other up and coming platform businesses that could eventually become that core. So I think, that's one of the things that that people are looking very closely at for Google and Google search is how well are they able to diversify. If search is starting to peak, then how well can they diversify growth into other areas? And they've now started to finally break out their YouTube revenue and some of these other business kind of composition of overall revenue to help start telling that story about, hey, here's our overall revenue makeup and how strong these other platforms are. But the crazy thing about Amazon is their core platform business, 26 years into the business, is still seeing such huge growth potential. Not to mention the other things that they have going for them, AWS and a myriad of other platform businesses that they've spun up over the years. Certainly are also seeing strong growth in their own right. So that to me is just why it's such why everyone just keeps talking about Amazon as compared to what's the growth story for some of these other companies.
We're talking with Alex Moazed, CEO of Applico. I'm Jeremy Schwartz. We have Kara Marsiscano, Rafi Aviav, talking about what's happening in these platform business models. Alex, one of the interesting things we talked a little bit about, Kara's point on how much dominating these companies are now in market cap and in a growing share of earnings. One of the questions is, when you think about creating access, we talked about how, WisdomTree licensed your signals for one of our ETFs now called the Growth Leaders Fund, formerly known as the Modern Tech Platforms Fund. But, we do believe these companies are growth leaders, but it's more than one sector, right? In the sense of, it's not just a quote unquote tech sector play. This is platforms are interacting across all verticals or different sectors. Do you want to talk about how the platforms are penetrating these different market verticals and where you see that, evolving over time?
Yeah, I think we have, the index has extremely strong differentiation, especially relative to, many tech indexes or other kind of high growth indices, which are just over-indexed in one or two sectors. So these platform businesses, it's not a sector-specific classification. Instead, because we're aligning around the business model, that's a horizontal classification that can cut across, theoretically, any industry that's out there. And I think when you look at the index, you actually see that from healthcare to financial services to hospitality to restaurants to travel. Let's see, just these general kind of general retail and niche retail, B2B retail, B2B kind of trading you're seeing in there, and then you have kind of the new form of media businesses, right? Social media, content platforms, which have kind of supplanted what you might regard as like traditional media. So you have transportation in here. You think about Uber and a Lyft, and then you have you have also some representation in like automotive with car marketplaces, or with like dating with Match Group. So it really kind of is, or SaaS software, like B2B SaaS software with like Salesforce, for example. So payments with Visa, MasterCard. So you really do have across, I would say, a nice horizontal swath across a variety of different industries that make up the overall economy. The question is basically, what are the best companies in each of these verticals? And the natural answer, or the answer that's going to be right 9 times out of 10, is, what's the fast-growing dominant platform business in that sector? And so that is essentially what has comprised this index. We don't look at every vertical and then pick out, this is a platform business. Instead, we just say, okay, what are all the companies that have platform revenue? And this is the basket, essentially. So you naturally just kind of, as a derivative of that analysis, get a nice cross-section across all these different verticals.
Well, this has been a fantastic conversation. Alex, Rafi, Kara, thanks so much all for joining. If you want to keep learning about platform businesses, Alex, you do your own podcast and YouTube series called Winner Takes All. Is that right?
Yep. Mm-hmm.
If people want to look for you, Applico and Alex Moazed are doing a lot of content on platforms. Kara's came on his show once. I'm sure we'll be on again. But thank you all for joining our discussion. I should note, investing involves risk, including possible loss of principal. Technology platform companies have significant exposure to consumers and businesses, and a failure to attract and retain a substantial number of such users to a company's product, services, content, or technology could adversely affect operating results. In addition, technology platform companies may face intense competition and the development of new products is a complex and uncertain process. Before investing, carefully consider a fund investment objectives, risk, charges, expenses contained in the prospectus available at WisdomTree.com. Read carefully. Distributor Foresight Fund Services, LLC. If you listen to Behind the Markets on SiriusXM 132, I'm Jeremy Schwartz. Have a great week, everybody.